This lecture is on Chapter 8, Accounting for Long-Term Assets. And one of the initial learning objectives we're going to take a look at is computing the cost of those plant assets. And then we're going to look at how wear and tear over time depreciates the value of it. And will take us from balance sheet accounting information to putting that wear and tear in form of a depreciation expense on the income statement itself. Now this is going to happen, we're going to have the acquisition cost as the initial thing we're looking at. Use is going to occur over time. That might be allocating the cost of the periods it's benefited and accounting for subsequent expenditures. And the fourth thing we're going to look at is going to be disposal. So recording how we're going to get rid of the asset. If we think about this in those three big groupings here, acquisition being what we pay for the piece of equipment or the value at the beginning, disposal being maybe its residual value or its salvage value, what it's worth at the end of its life, and then use being that wear and tear that occurs over time. You can start to see how that depreciation calculation is going to take hold. Now the acquisition cost, computing that, we're going to take the purchase price initially, but if you remember when we looked at inventory costs, we would include shipping costs for FOB shipping items, and then FOB destination items would have that already incorporated into it. So here for our equipment and other assets, for long-term assets, the cost determination, we do include the purchase price, but we're also going to include all expenditures needed to prepare the asset for intended use. So that similarly is going to include those transportation charges. It may include taxes that are going to be paid, and broker fees and commissions may be included as well. When we're talking about depreciating those off over time, it's important to know that whereas structures such as like a building might get depreciated, as would equipment, land itself won't be depreciated over time. So the land will not be improvements to it, could be the structure of the building, could be, and then equipment that we purchase could be. So that begs itself, what happens if you have a lump sum purchase? You go and say purchase $90,000 for a piece of land that has a structure on it. How do you allocate that $90,000 among what part is for the structure and what part is for the land? And so what we're going to do is we're going to portion that or allocate that based on relative fair market values. So in this example, if the building or the structure was appraised at $60,000 and the land and its improvements was appraised at $40,000 for $100,000 total, the building would be 60% of that appraised value. So we take 60% of our $90,000 cash that we paid, or $54,000, and allocate that to the building. And then we take the 40%, which is represented by the land, multiplied by the 90,000 to apportion 36,000 to the land value. So the next thing we're going to do is look at depreciation amounts and calculations. And there's going to be three different methods we're going to take a look at. One is going to be the straight line method, one is going to be units of production, and the third is going to be declining balance method. So no matter which method we choose, depreciation is going to take the acquisition cost, paying cash for a piece of equipment or that transformation that we've done, and take the expense, the wear and tear that's happening over time, and include that expense on the income statement as the piece of equipment is getting used up or the structure is getting used up. In doing so, in order to calculate how much depreciation is going to be expensed on the income statement, we need to know three different factors. One is going to be what's the initial value or what's the cost that we paid for the asset itself. Two is going to be the salvage or residual value, so what is it going to be worth at the end of its life. And the third piece is how long is this useful life going to be? How much wear and tear is going to get, how much is the span of time that this wear and tear is going to get taken out on the machine before it reaches its salvage value. So of those three methods, straight line method, units of production method, and declining balance, we can take a look at fact pattern here and kind of put that in place with examples for each of them. So let's assume our piece of equipment has a cost of $10,000. We assume its residual value or its salvage value will be $1,000. So this may be, if we think about our coffee shop example, purchasing the piece of equipment that will grind the coffee beans up for us. The cost of $10,000 may be what we paid for the machine. After a span of time, it may not be worth anything for making the coffee beans ground up itself, but the machine itself might be able to be sold off for scrap metal and melted down or something like that. So it may still have value, even though it's not of value in its intended purpose for us. So the third thing we want to know is what's going to be that useful life. Here, we're estimating it at 5 years. So we think it's going to be worth 5 years as a piece of equipment and worth $1,000 at the end of it. So over the course of that 5 years, $9,000 worth of wear and tear is going to happen on that machine. Now, useful life, we also want to know how many units are going to be produced. So we may, here we got 36,000, so we may produce 36,000 in the coffee example, cups of coffee. The example that we're going to use here and kind of see is actually going to be shoes. So it's going to list the units as 36,000 shoes. So using the straight line example, we're going to take our cost minus our salvage value to get that $9,000 in depreciable cost. And we're just going to divide by the years for the useful life to get 5 years. And that's going to be $1,800 for the depreciable amount in that period, in that year. We would debit depreciation expense by the $1,800 and then credit accumulated depreciation by $1,800. So similar to what we saw in the last chapter with allowance for doubtful accounts being a contra asset, here we have accumulated depreciation that's going to do a similar function for us. So you can see in the straight line method, we're going to have $1,800 of depreciation each of those 5 years, and then our accumulated depreciation is going to build by $1,800 each of those years, which our net value for the piece of equipment will decrease by $1,800. And at the end of the 5th year, we'll have $1,000, which is the salvage value for the net value. So it would be a gross value of $10,000 minus $9,000 for accumulated depreciation, leaving us with $1,000 for the net value. Taking a look, you can see it a little bit more straightforward tabled out. 9,000 is going to be the depreciable cost. 20% or 1 divided by 5 years will give us our 1,800 in depreciation expense each year. And we can see the accumulated depreciation after the first year is 1,800, and it increases by 1,800 in each of those years. And then the book value is going to decrease by 1,800 until it gets to the salvage value at the end of year 5. It's important to note, no matter which method we're choosing, each of those methods will get to that salvage value at the end of the useful life. So the units of production method, we're going to have a two-step process here. One is we're going to want to calculate the depreciation over the cost, 10,000 minus the salvage value of 1,000 to get 9,000 depreciated. The useful life here is going to be measured in the total units of production. So the useful life is going to be 36,000 units, which will give us 25 cents per unit. And we're going to take that 25 cents per unit, multiply by the number of units each of those years. So unlike the straight line where we had 1,800 every year, here we're going to have some variability. So some years it might be more depreciation if we produce more items, and some years it might be less. But we always will have to be given or know what that number of units produced in the period is. So let's say we're given 7,000 for the units of production, then we would take our 9,000 wear and tear divided by 36,000 units to get our 25 cents per unit, multiply 25 cents by the 7,000 units to get 1,750. So here we're a little lower than the 1,800 we saw with the straight line. And tabled out, we're going to see something similar to where we've got the number of units we're given, and that it's going to total to 36,000 over the 5 years, 25 cents per unit. And depreciation expense is going to be a little higher in some years. You could look at year 2021 where it's a little higher. It's going to be a little lower in others. So 2023 and then 2019 and 2022, we're estimating that as a little lower. But again, the book value is going to converge on the salvage value at the end of that 5th year. And so double declining is going to be a little bit different for the calculation. Here we're going to have a few steps. So what we're going to do here is take a look at what the percentage would be for the straight line rate divided by the useful life. So if we took 100% of our value divided by the 5-year useful life, we get 20% for the amount taken every year. We saw that in the table for the straight line method. Double declining is going to mean we're going to quite literally double that straight line rate. So 40% is what we're going to use here. And we're not going to include the salvage value in terms of the base that we're multiplying that 40% by. So we'll take 40% times 10,000, the beginning period book value, to get 4,000 for 2019. Now, the base is going to change each year, and then we're going to have something called a plug at the end, and we'll see how that looks. So here we take our 10,000 times 40% to get 4,000. That would be the accumulated depreciation. So we've got a $6,000 net value at the end of 2019, at the end of year one. 6,000 is then going to become the base that we multiply 40% by in the following year. So in year two, we take 6,000 times 40% to get 2,400. And we add the 2,400 to our 4,000 accumulated depreciation to get 6,400 accumulated depreciation after the second year, which leaves us with 3,600 after year three. So we're going to rinse and repeat this process for 2021 and 2022. 1,440 depreciation expense in 2021, 864 in 2022, which yields us 2,160 for a net book value in 2021, and then 1,296 at the book value at the end of 2022. So here is in year five is where things are going to get a little different, and that's because we're going to take that book value at the end of 2022, the 1,296, we're going to multiply it by 40%, the same as we would in each of those 5 years. This calculation would yield us $518 for the depreciation expense. We can't take that much depreciation because it would make the accumulated depreciation over 9,000 and make the book value under 1,000. If you remember, we have to, at the end of the useful life, always, no matter which method, converge on the book value of the salvage value, or the residual value at the end of the year five, at the end of the useful life, here in this example, 5 years. So we're going to actually force that value by putting $1,000 into the ending book value. Accumulated depreciation, we're going to force at 9,000, and then we're going to back in or use a plug number or forced number of 296 just to make that math work. So in the last year of the double declining balance, the depreciation expense taken is going to be whatever's left to make the salvage value of the ending book value. So if we compare those, we can see the straight line method is the same every year. I would add to 9,000. Units of production has some variability, but always adds to 9,000. Double declining is going to shift a lot of that depreciation expense up front, and then decline over time, but still add to 9,000. So the methods used by most companies, straight line is going to be overwhelmingly what is selected, and it's fairly intuitive and fairly ease of life. Ease of use over that life. We're going to have some still preferring some other type of accelerated method, a declining balance, or some using the units of production. So, but the 85% of companies will pick that straight line. And then it's going to be different for tax reporting. So tax reporting is going to use MAKERS, so the Modifying Accelerated Cost Recovery System, and that's going to be essentially tables that the IRS provides based on the type of property. So you're going to have some property that might get depreciated based on its classification over a set amount. So the IRS will quite literally tell you, if your piece of equipment fits here, this is the useful life you're going to use, and this is the depreciation schedule you're going to use for it. So we may also have not always start on January 1, and we may have estimated our salvage value, for example, at 1,000, and then a useful life at 5 years. But 2 years into the calculation, we may realize that we've made a mistake on one or both of those. So how do we handle those two situations? For partial year, we're going to take a look for the amount of expense taken over that span, so just pro rata. So if we are looking at October, November, December, we'd have 3 months of year one. So we'd still take our 1,800 expense, but we'd only take the 25% of 1,800 in the first year. And then years 2 through 5 would still be 1,800 per year. And then we're going to have a year 6 that's going to have months January through September. So we'd have the remaining part of that 1,800 not included in year one, that's going to wrap around to year 6. So we'd have 1,350 in the final year. Now, if we have a change, so let's say we get 2 years into it and we realize that instead of 3 years remaining, that it's actually going to be 4 years of useful life remaining, and then salvage value maybe we thought was 1,000, but it looks like it's only going to be worth 400 because the value of the metals decreased or something along those lines. Once we get the new information, we're going to freeze right there, figure out where we are in terms of the book value, where we are in terms of any revised salvage value, or the same if no change has been made, and figure out what the remaining useful life is with all the new information. And we're going to calculate a new depreciation expense off of that new information and then just go from there. So we're not going to retroactively change anything we've previously done. And then looking at revenue and capital expenditures, what this is going to come down to is if we're fixing the piece of equipment. So let's say our coffee machine breaks down a little bit. Any repairs we do to keep it running is going to be a repair expense and get expensed in that same year, and then we're going to credit cash for the amount. If we're going to fix it up, if we're going to improve the value of it, then we're going to add that amount referred to as a betterment to the asset itself and depreciate the betterment. So if we put a better motor on it, for example, rather than just fixing an existing motor. So if it's an upgrade to the asset, we're going to depreciate that upgrade, and the cash is still going to be that credit. So it's whether or not the debit is in adding to the asset itself, referred to as a capital expenditure, and then depreciated subsequently, or whether we expense it in the current year for an ordinary repair. And then looking at our disposal and discarding, for an asset that's fully depreciated, what we're going to do here is assume that a machine costing $9,000 with accumulated depreciation of $9,000. So we've depreciated everything is worthless on our books, or worth zero on our books. We've depreciated it over the 8 years with zero salvage value. When we fully remove it, we have on our balance sheet still for the zero net value of an asset, which is a debit account, for $9,000, and we've got our contra account, which is a credit account for $9,000. So we're going to do the reverse. So we're going to debit accumulated depreciation by $9,000 to remove that, and we're going to credit the machinery or the equipment by $9,000 to remove it. So if we sell the plant asset, if we sell it at book value, then we're going to have, over time, we're going to take our depreciation expense, credit our accumulated depreciation. If we sell that asset that's worth $3,000 in net value, we're going to debit cash by $3,000. We're going to debit the accumulated depreciation back, removing it, and we're going to credit off the $16,000, which was the original, the gross value, the original book value. So this is going to be the way in which the journal entry is going to both unwind the accumulated depreciation and the gross expense, the gross asset value on the balance sheet, and then account for that cash. And it's going to be a little different if it's done at a gain or a loss as well. So if we're above book value, we're going to have a gain that's going to be recorded. We're going to do that by debiting the amount of cash. Here, $7,000. We're going to have that same accumulated depreciation that's going to get debited off, giving us $20,000 in debits. We're going to have $16,000 that's credited off for the gross amount, and then we're going to have a gain of $4,000 that's going to be a credit here, similar to how we would book revenue as a credit. And you can see that the accumulated depreciation would give us $13,000, $16,000 for the original cost, so $3,000 would be the amount we're carrying it on our balance sheet for. If we had a $3,000 asset we sold for $7,000, we would think of it as a $4,000 gain intuitively, so that $4,000 credit that we have kind of links back to that and should be intuitive with respect to that valuation. With respect to a loss, we're going to just do the converse. So here we've got depreciation taken over time. Here we have carried on our books what we have listed as $3,000 for the net value. We sell it for $2,500 in cash. It's going to feel like a $500 loss. So we're going to list that same $13,000 in accumulated depreciation as the debit. The equipment is a $16,000 credit to take the gross amount off. Cash received is going to be $2,500 for the debit, and then we're going to take the loss as a $500 loss on disposal of equipment, which is going to be a debit, and that's similar to how the revenue being a gain, the revenue being a credit kind of lines up with the gain being a credit. Our expenses and cost of goods sold being a debit kind of lines up here with that loss being a debit as well, and should similarly be intuitive in terms of the $500 loss lining up with selling something that was worth $3,000 for $2,500 would be that same $500 loss that we suffer on the transaction. This would conclude Chapter 8's lecture.